Good day, ladies and gentlemen, and welcome to your Q3 Market Webcast. All lines have been placed on a listen-only mode, and the floor will be open for your questions and comments following the presentation. If you would like to submit a question at any time during the webinar, you may use the chat box located on the lower left corner of your screen. Simply type your question into the box and click on the send button. If you should require assistance throughout the conference, please press *0 on your telephone keypad to reach a live operator. At this time, it is my pleasure to turn the floor over to your host, Jordan Kahn. Sir, the floor is yours.
Okay, thank you, operator, and thank you, everyone, for dialing in today for our Q3 2018 markets update. Today, we're going to change the format a little bit, and we're going to do a top 10 list of our top 10 reasons to expect new highs for stocks this year. Okay, so let's get into it. Number 10. Number 10 is jobless claims. This is a chart of initial unemployment claims. It comes out every week. And what you'll see here in this chart is that since peaking up here at around in 2009, jobless claims have really been on a steady decline basically for the last 10 years. The most recent jobless claims that we've seen have actually hit their lowest levels since 1969. So we're at almost a 50-year low in unemployment claims, which is clearly a positive for the economy. It has helped bring our unemployment rate all the way down to 3.9%. And this is something that is, low unemployment when you have a lot of people that are employed. Obviously, that's supportive for consumer spending. And given that consumer spending is roughly 70% of U.S. economic growth, this is why we've listed this as an important positive indicator for the market. Moving on, number 9 is interest rates. Again, this is a long-term chart that we've shown of interest rates. It's roughly about a 50-year chart. And this is a chart of the 10-year Treasury yield. So this is the interest rates that are set by the market, not the overnight rates that are set by the Fed. And what you'll see here is that basically since peaking all the way back in 1981, interest rates have been moving steadily lower since then, all the way down to their lows a couple years ago in 2016. So since 2016, we've seen a little bit of bounce in rates, but really what this chart shows you and what it helps put in perspective is that interest rates remain low historically. So right now, the 10-year yield is close to about 3%. On this chart, it wasn't even until the last financial crisis, kind of late 2009 timeframe, that interest rates really got below 4% and stayed there. So down around 3%, interest rates are still at low levels historically, and anywhere in this range, in this 3 to 4% range, let's call it, we would still consider that healthy for the overall economy. I mean, low interest rates help support a credit-based economy like we have here in the U.S. It helps lower debt payments for both households and corporations. So that has really helped over the last 10 years. That has helped, again, both households and corporations improve their balance sheets. And obviously, so this is another positive overall for the markets and for the economy. Number 8 is low inflation. This chart is of what's called the Personal Consumption Expenditures Index, or the PCE index. This is the preferred inflation gauge that's used by the Fed. And what you can see on here is that inflation has remained pretty tame in recent years. The Fed has set out this 2% target. You can see this line on here in green where it shows this 2% target. That's the target that the Fed has put out. And most recently, if you look at the core rate of inflation, which is, it takes out some of the more volatile food and energy prices, but the most recent reading in the core rate has actually been 1.9%. So the current levels are just reaching the Fed's target, and a little inflation is actually good for stocks. You don't want to see inflation going below 0 like it did in the 2008-2009 timeframe, because that really gets people concerned about deflation. So what you really want is a little bit of inflation, not too hot but not too cold, kind of like a Goldilocks environment. And that's really, the area that we're in now. So This is another thing that's good for stocks. Low inflation helps boost overall valuations and stock prices. So we see this as another positive. Number 7 is U.S. economic growth. This chart shows GDP growth here in the U.S. on a year-over-year basis. What you'll notice is that for the last 8 quarters, we've had a nice upward trend of accelerating growth in the economy. So that 8 quarters of accelerating growth provides a strong tailwind for the economy. The most recent quarter, GDP posted a quarter-over-quarter growth rate of 4.1%, so pretty high level, something that we haven't seen in a while. Q3 is projected to be fairly strong also. So right now the economy is basically firing on all cylinders, and this should continue to provide a strong tailwind for consumers as well as businesses. So strong economic growth is certainly a good factor for the markets going forward. Number 6 is business optimism. This is a graph of the NFIB Small Business Optimism Index. So it's a survey that's taken monthly amongst small businesses to gauge how they feel about the business environment and their current prospects and that sort of thing. What you'll notice here is that recently this index hit an all-time high. And this is going back, I believe this index has been in effect for about 45 years. So we're reaching all-time historic highs in this index. One of the reasons that business optimism is so high among small businesses has certainly been the tax cuts that have been enacted. So tax cuts have helped small businesses to lower their taxable expense, increase cash flow. It's helped lead to stronger growth. Also, a decrease in some of the onerous regulations on businesses has helped. So higher optimism is good. It usually leads to more spending on the part of businesses, more capital expenditures, more hiring. That leads to consumers, more income and more spending. And really what you're trying to get into is what you would call this virtuous cycle, where you have more capital expenditures, more investment, more hiring, and more spending, and it just continues to kind of feed on itself and keep the economy strong. So this is another positive factor. Number 5, this is the Leading Economic Indicators Index. So this is an index put out by the Conference Board, which is an independent nonprofit organization that reports on several different economic indicators for the U.S. And what you'll see here is that this index on the right side is also making new all-time highs recently. Another thing that's interesting to point out on this chart is that if you look at these shaded areas, which I'm going to highlight, all of these shaded areas represent recessions. Okay? And so one of the things you'll notice, if you look back over the last 6 or so recessions in the last 50 or 60 years, is that each time you saw a topping process in the leading economic indicators, you saw this index kind of form these rounded tops prior to going into recession. So, for people that are on recession watch, first you need to look for a topping in this indicator. And right now, we haven't even seen that yet. So this indicator is still making new all-time highs. And that means that we are still probably a ways away from the next recession. First you would have to see this thing kind of start to roll over before you would even begin to look for the next recession. So it's hard to gauge exactly when something like that might happen. Gun to my head, I'd probably say that the window or the time frame with which to start to look for that is maybe 6 months at the earliest and probably 18 to 24 months at the outset. So this has been a good indicator, this LEI index. The components that go into this index are things like jobless claims that we talked about, new orders in the manufacturing sector, building permits in the housing and construction sector, stock prices, how the stock market overall is doing, the spread between long-term and short-term interest rates or the yield curve, as well as consumer confidence and consumer expectations. So there are a basket of things that in the past have done a good job on helping to look forward in the economy as opposed to things that are more coincident or lagging type indicators. So new highs in the LEI, another positive for the stock market. Number 4, we have record buybacks or record stock buybacks. So again, one of the things that we've seen a lot of this year, mainly due to the tax cuts that have been enacted, is that because of the tax cuts, corporations are flush with cash, and they have been using a lot of this to increase share buybacks. So you see here on the chart, Q1 was a record high in share buybacks. Right now, Q2 is on pace to also be a record. And if you include not only just the share buybacks, but also the increase that we've seen in dividend raises from corporations. So the tax cuts that have led to increased cash flow, also the repatriation bill, which led to corporations bringing hundreds of billions of dollars back to the U.S. from overseas. So some of that money went to capital expenditures. So capital expenditures are up about 21% so far this year. So some of that money has been reinvested. But certainly a lot of it has been returned to shareholders in the form of share buybacks and dividends. And both of those are stock market friendly. If you look at the pace of share buybacks and dividends this year, they're on pace to top $1 trillion in 2018. Trillion with a T. So that would be shattering any of the old records. And buybacks are particularly positive for the stock market because they lower the overall share count and thus immediately boost earnings per share or corporate profits. So record buybacks, another strong tailwind for the stock market. Number 3 is market breadth. And this is a chart of what's called the advanced decline line. The advanced decline line really measures on a daily basis the number of stocks that are advancing minus the number of stocks that are declining. So on any given day, if you have more stocks advancing than declining, then the chart moves upward. And market technicians use the advanced decline line really as a barometer for the health of the broader market. So when the breadth of the market is healthy and the advanced decline line is moving in an upward fashion, that's usually very supportive of stocks. It's a good sign for stocks, and it means that the market is healthy. If the market were making new highs and the advanced decline line were going down, that would kind of be what we call a negative divergence. And what that would mean is that the market is moving up and it's being driven by fewer stocks each day. So good market breadth means that the market is rising and lots of stocks are participating. This chart was actually printed a few days ago, and if you updated this today, what you would see is that the advanced decline line has actually broken out to new highs. So it's another good sign for stock markets. Market breadth is healthy. There's a lot of stocks that are participating in this advance. And it's another reason why we expect continued new highs for the year. Number 2 is earnings growth. Earnings growth is a huge factor that we talk about quite a bit. It's one of the primary drivers for stocks over the long term. And if you look at this chart, you might recall that for those of you that were on our first quarter webcast, what we talked about is that due to the tax cuts and all of the buybacks, analysts were really scrambling to revise their earnings estimates higher. And so you saw this dotted line here represents the earnings per share of the S&P 500. And what we saw in the beginning of the year was this really sharp spike higher as earnings estimates, got ratcheted higher. This coincided at the same time with a run-up in the stock market that eventually peaked. Since this January peak, we know what stocks have done. They have mostly gone down. In February and March, we saw that big correction, and then they've kind of chopped around since then. But what's interesting about this chart is that while stocks peaked and have chopped around, if you look at the dotted line has only continued to move higher. So the underlying earnings growth continues to be strongly supportive of this market, with this line still rising. And it probably means that it's unlikely that stocks have seen their peak. Last year, earnings or corporate profit growth grew about 17% overall for the market. This year, earnings are estimated to surge about 27% on a year-over-year basis, and the early estimates for 2019 are for earnings to grow another 12% overall. So if you look at where the stock market is today relative to where earnings are expected to be next year, and we try to put what's called a PE, or a price to earnings multiple, on that, what we see is that the S&P 500 is trading at about 16 times next year's earnings, which is certainly a very reasonable number, not only just historically relative to where PEs often get in the later stages of a bull market, but also relative to where interest rates and inflation are today. So if you look back historically at time periods when interest rates and inflation have both been as low as they are today, it's often supportive of higher valuations in the market. So we could easily see the PE on this market expanding from here, which would obviously coincide with higher prices than we have today. So this is the number 2 tailwind that we see supportive for higher stock prices as moving forward, is the strong underlying earnings growth of the market. And the number 1 reason why we continue to expect new highs for the year is the recent technical breakout that we've seen in the market. So this chart is of the S&P 500. Earlier in the year, when we saw the sharp pullback in the January-February correction, we saw after stocks bounced, they kind of ran into resistance right around this 2,800 level on the S&P that I've highlighted. So I drew this green line at the 2,800 level to show this resistance. After the stock market bounced back to this level in March, pulled back again and chopped around. In June, we made another push almost back towards this 2,800 level. Market pulled back again. But then more recently, the most recent trip up to the 2,800 level, the market was actually able to break through it. And then in the last couple of weeks when we saw a pullback, the market nicely found support right at that 2,800 level. So what you've seen here, and this is kind of classic technical action, is that a line like we've drawn here in the 2,800 level, it used to be what's considered resistance, meaning that it was providing resistance each time the stock market reached that level. The stock market was bouncing off it and turning lower. Now that the market is broken above it, they say that resistance becomes support. And so that's what we've seen. The stock market broke through the 2,800 level, and then on its first trip back down, that resistance turned into support, and we saw the market bounce off of the 2,800 level. Again, this chart was printed a couple of days ago. If you updated this to include today, you'd see that this final line on the right has actually gone above 2,850. So the S&P 500 is currently less than 1% off of its record high, and I noticed that the S&P 500 is more of a large cap index. If you look at a smaller or a mid cap index like the S&P 400, the mid cap index actually hit new record highs today. So the technical breakout is another strong indicator that should bode well for more new highs as we go along. The market made its early high in January, so basically it's been correcting and trading sideways for the better part of 7 months. That sets up kind of a nice long base from which a new breakout that we're starting to see should lead to higher prices. This year also has the distinction of being a year that we have midterm elections. Typically, if you look at the seasonality in a midterm year, you often see the summer months have some choppiness to them, but as you get closer to the midterms, and certainly once you get past it, once that uncertainty from the midterm elections gets removed from the equation, usually the markets have a strong finish to the year. So we think that this year it's likely that it could play out in similar fashion to that. We've seen a lot of choppiness in the early part of the year with the correction that we saw. Recently the market has actually been acting better even when we've seen negative headlines. Each of the pullbacks that we've seen recently in the face of negative headlines have been kind of smaller than we saw in the early part of the year. And so we think as we get closer to these midterms, and once we get past it, that the market should have a nice strong finish to the year. So that is our top 10 reasons why we think markets will continue to see new highs for this year. And I will now turn the call back to the operator for questions.
Thank you. The floor is now open for questions. If you do have a question, please press star 1 on your telephone keypad at this time. Okay, and it doesn't look like we have any questions coming in.
Okay, there's a couple that are in the chat box from people that are online, so let me just read those. One of them says, what about the trade war? So the trade war is a bit of a wild card. You know, in terms of the tariffs that have been enacted so far, they're kind of affecting a very small subset of the market, and so you know, while not trying to diminish their economic impact, in terms of what they mean for the stock market, they haven't really put a dent in the underlying earnings growth. I mean, if I flip back a page and you look at this dotted line, which shows, you know, the recent trend in earnings growth, you wouldn't even notice anything here about tariffs or trade wars or anything like that. So, you know, really the tariffs have become more of kind of a negative headline you know, sort of thing. And so what we've seen, as I mentioned before, is that when we first started talking about tariffs and we first started hearing about them in the news, it was causing a lot more volatility in the market. Lately, as we've heard, you know, more and more on these tariffs, each time they've caused shallower and shallower pullbacks in the market. So I think that the market isn't overly concerned with the way that the tariffs and the trade war talks are going. You know, there's a lot of strategists who think that this is likely, you know, posturing ahead of the midterm elections, and that Trump will likely try to dial back the rhetoric before we get into the midterm season. So, you know, if the trade war turned into something, you know, significantly more serious than we've seen so far, and it started to affect more industries, then it could impact things. You know, so I would put it in the category where it is a wild card. It doesn't really seem to be, you know, overshadowing the other positive factors that we've talked about in terms of the strength of the economy right now and the strength of the underlying earnings growth that we're seeing. Okay, we have another question. Municipal bonds guesstimate. So municipal bonds are in pretty good shape. They've been performing fairly well in the face of rising interest rates this year. Muni bonds, like most bonds, do have two components to them. They have the underlying interest rate sensitivity. So if interest rates are moving higher, that's always a headwind for bonds. But then they also have the underlying credit qualities that go with the municipalities that are being underwritten, right? If you have a California state muni bond, you know, its price also reflects the strength of the California economy. So on that front, you know, most muni bonds have been doing fairly well because the U.S. economy is getting better. Most states have been, you know, benefiting from the increased economic activity. So relative to some other areas of the bond market, you know, I think muni bonds are holding up fairly well. They're not going to be immune to the rising rate environment, but I'm not overly concerned about them either. Let's see. Another question says, does your perspective on the economy suggest that one might augur up or down a little bit from their baseline risk tolerance? You know, I would say in this environment, given that we are exiting or coming out of the big correction that we saw in the first half of the year, and that I think there's a lot more positives in the economic landscape than there are negatives, I would say, given one's personal risk tolerance, that they would likely benefit from being, I guess, slightly more aggressive incrementally than their baseline risk tolerance would otherwise be. Hopefully that answers that question. I think that's all the questions that we have in the chat box. Operator, are there any other questions on your end?
Again, ladies and gentlemen, if you would like to ask a live question, please press star 1 on your telephone keypad. There are no questions in the queue.
Okay, great. Well, then we will leave it at that. Again, thank you everybody for dialing in today for our Q3 markets update. And if you have any other questions that come up going forward, please reach out to us. So thanks again.
Thank you. This concludes today's webinar. We thank you for your participation. You may disconnect your lines at this time and have a great day.